What's up, guys? Josh Weidman here with TCS Investments. Today I want to talk to you about cap rates and how much I hate cap rates. Oftentimes a cap rate or a capitalization rate is used to disguise or omit certain income numbers or certain expenses that are going to offset or impact the bottom line when you're analyzing your numbers. The capitalization rate, really simply, it's a ratio of the net operating income to the total investment. All right, so for instance, a 10 cap would be a property that nets, after all expenses, $10,000 a year on a $100,000 investment. Okay, the reason I hate cap rates so much is that oftentimes they're used by wholesalers, bird dogs, other investors, realtors, whatever, to hide numbers. So I guess what I'm really saying with this video is that you have to be realistic about your numbers. First, you got to be realistic about the rental rates. What is the current rent? If the building's occupied, what are the tenants actually paying today? I don't care if that number's below the current market. That's what the number is today. If the place is vacant, you have to look at the real numbers and what you can expect on rent. A great place to look for this is rentometer.com. If you sign up for a pro account, it's really inexpensive, but you're able to actually delve in and see some of the properties that have rented recently in the area. Number two, vacancy rate. So a lot of times I'll see a 5% vacancy rate on a single family or a multifamily home. Well, you don't really know what that's going to be. If you've got a trashed property, the turnover is going to be much higher. You're going to be looking at a longer period of vacancy between tenants, and eventually your maintenance costs, that's another issue that we're going to look at, are going to be higher. So you got to be realistic with maintenance or with your vacancy rate. If you have a tenant or an apartment that turns over every year, and it takes you 1 month to clean up that property and put a new tenant in, you've got a vacancy rate of 8 1/3%. Right? That's 1 month over 12. So you're losing 1 month every 12 months. If the tenant stays for twice as long, if they stay for 2 years, hey, it's half of that. But if it takes you 2 or 3 months of vacancy in order to fill a unit, I mean, the vacancy rate can be really big. So you got to be realistic on that. Number two, let's look at expenses. Everybody puts in taxes and insurance. Okay, great. In addition to that, though, if you're in Philadelphia, there's a $50 per unit per year fee from the city. It should be probably $52 unless you want to trudge down to the center city to get your license. You can do it online for $52. You've got a leasing fee. Even if you're placing the tenant yourself, it takes you time, it takes you effort. Charge 1 month's rent every, depending on the life of your tenant, but 1 month's rent to place a tenant. You've got management fees. Again, even if you're doing it yourself, you got to put it in the calculation, because if you only have one rental property or two rental properties, you're going to get to the point where you're going to want to expand, you're going to want to grow, and you're going to need to have that worked in there when you want to turn it over to a management company. You're going to have other things are your maintenance. You've got to calculate a certain amount of money on an annual basis for maintenance. If the property's in great shape, maybe that's a low number. It can be low as maybe 5-8%. If the place is not in great shape and it's a fixer-upper, and you know that there's going to be a lot of repairs, be realistic about what it's going to cost on an annual basis to keep that place rented and keep it working properly. Last, you've got your capital expenses. What I'm talking about here are expenses to continually upkeep the property. You've got your heater, you've got your roof, you've got windows, you've got flooring, kitchens, bathrooms, plumbing, electrical. All of these things need upkeep over time. If for instance, to calculate your capital expenditures, let's say it costs you $2,500 to put a roof on, and the lifespan of that roof is 10 years. Okay, you've got to calculate $250 a year towards capital expenditures to replace that roof. You should do this for each of your mechanical systems and put a calculation in place so that you can continually upkeep the property. So at the end of the day, cap rates are a great way to get a snapshot of what a property or how a property is going to perform if they're used properly. If they're not used properly, it's a great way to skew the numbers and to give a return that's not going to be actualized or realized. So whenever you're looking at a cap rate, make sure that you delve deeper than that bottom line number. Take a look at all of the income and expenses and calculations that are involved in getting to that bottom line. That's it for today. I wish you the best of luck in your real estate investing, and I'll see you again soon. Take care.